Good day, you're speaking with Naso Carstens from PSG Wealth, and I'll be taking you through the Truworths International EIA. Starting out with our executive summary, we had our first half of 22 trading update. We had fairly good results coming up from a low base. In terms of macro, our revenues are highly dependent on macro factors such as interest rates, total income and inflation. These should have a mixed, albeit positive effect on revenues. In terms of our valuation, we have intrinsic value of R65.95, which implies a 19.1% upside. Based on our qualitative and quantitative factors, we rate the stock as a buy. In what would change our mind? Income growth and inflation. That would be income growth lower than the 8.5% forecast and inflation higher than our forecasted 7%. Right, so we had our first half of 22 trading update. We had moderate top-line growth with strong earnings growth. This was due to fewer markdowns and stock carryover, which supported margins. Margins were also supported by lower impairments, Sasria insurance payouts, and foreign currency gains. We did see a normalization of trading conditions in the UK office segment. However, space in the segment is still being constrained to preserve the more profitable stores. We saw credit growth lagging peers, however cash sales did rebound in contrast with peers. This is likely attributable to a few different factors. The debtors book was fairly flat at about 5.9 billion rand. In terms of our macroeconomic factors, we rate these three factors as being some of the primary determinants in terms of revenue growth and revenue changes. We see interest rates coming up from a historically low base, and this has been a major but not a deciding factor. Then we see total income and inflation being the primary drivers of revenue and discretionary spending. We forecast a 8.5% growth in total income, which consists out of private and public sector wages and grants. And then in terms of inflation, we do see food inflation accelerating. However, this should come in below the absolute wage growth, and just given the law of large numbers, consumers should find some room for clothing and apparel spending according to our forecasts. In terms of total income growth, this is very difficult to measure ex ante. However, we are seeing through the news and through various sources, we're seeing in the private and public sector higher wage growth materialize. In terms of state wage negotiations, coming through from the mines, we are seeing a higher, so 8.5+% materialize. This graph just shows you interest rates. That top graph shows you the repo rate over the past 20 years. So you can see that we are hiking, we're on a hiking cycle. However, we are coming from a very, very low base. So even though we are hiking, we are still in a low interest rate environment, and we would have to hike at least another 2% or so to reach the longer term average. The bottom graph just shows you performance over the different interest rate cycles. It is a constituent index out of Mr. Price, Truworths, Foschini and Woolworths. You can see prices were definitely impacted by interest rates. However, it wasn't the deciding factor. We rate consumer income and inflation and the interplay between those two forces as the primary driver of revenue and revenue growth. Okay, in terms of valuation, just to give you some background on how we think of valuation, we rate the stock based on qualitative and quantitative factors. Quantitatively, we find Truworths quantitatively undervalued based on PE and EV/EBITDA trading multiples. Our valuation upside, as we said, is 19%, and that underlies our quantitative argument. In terms of quality, we qualitatively rate Truworths very high. Truworths still has the highest margin amongst peers and has demonstrated effective cost control, which provides some room for bottom line growth. Valuation is also supported by a disciplined dividend policy. We have substantial share buybacks of about 15% of the past 5 years, and they have guided that they will continue this policy for the foreseeable future. Truworths is also likely to benefit more from rising interest rates, more so than peers. Considering these two factors, we rate Truworths as a buy. Then it's also worth noting that in terms of qualitative risks, we have two primary risks, primarily management and market share. In In terms of management, Michael Marks has been with Truworths for about almost 30 years. This in and of itself isn't a risk. However, there is a continuity issue there. For instance, if you were to leave unexpectedly, abruptly, or just retire, this could have a negative impact. So there have been some succession plans in the future that have fallen through. However, Sarah Proudfoot has been nominated in the current succession plan, and this should provide a smooth transition period. Then in terms of market share gain, Truworths has been using market share over the past few years. In terms of market share gains, we can break up those changes into two factors: M&A activity and organic growth. So in terms of M&A activity, we have seen quite a lot over the past 5 years. Foschini, as you can see there in those grey bars, has been growing aggressively, primarily due to assets bought up in the market in their very aggressive diversification strategy. Also, assets bought up from Edgar's, some profitable assets bought up from the Edcon group. Then the second component is fashion risk, and this is essentially just how the market, or the premium and aspirational market, rates fashion. Now, this is very difficult to measure, as you can imagine. However, I've heard it said quite a few times in the analyst community that Truworths lags in terms of fashion. However, I personally ascribe less merit to this, just due to the fairly high inventory turnover in these businesses, which implies that logically they have much more room to correct within the year, especially over multiple years. That's why we would make the argument that most of this market growth share we're seeing for Foschini, as opposed to Truworths, is likely due to M&A activity. This does also reflect on Foschini's balance sheet, in contrast with Truworths and Mr. Price, where Foschini has a considerably higher debt load and interest burden. Right, so this graph just shows you, in terms of valuation, our three scenarios, how our thinking is laid out, and then there on the right-hand side of the graph, you can see our value-weighted, probability value-weighted intrinsic value of 66 Rand. Thank you very much for listening, and please contact one of our traders if you'd like to place an order.